This is Haystack Help Radio on KLZ 560. Haystack Help Radio is powered by HaystackHelp.com. Finding help can be like finding a needle in a haystack. But with HaystackHelp.com, finding the needle just got easier. Now, Haystack Help Radio with Scott Watley on KLZ 560.
Good afternoon and welcome to Haystack Help Radio. Thank you so much for joining us today. Check out our website, HaystackHelp.com. There you'll find a lot of great companies to do business with and businesses that we have checked out as well. Today is a special edition of Your Money Matters, brought to you by our good friends at Affordable Interest Mortgage. Mr. Kurt Rogers is with us in studio. Their number is 720-895-0500. Affordable Interest Mortgage, your one-stop shop for all your mortgage needs. So, Kurt, any updates in the mortgage world we want to talk about?
Well, the thing that most people don't want to hear, rates are going up.
Okay.
You know, you hear when the feds are saying they're going to raise the rates, but nobody talks about it when the rates are getting raised without the feds.
Right.
And rates over the last week have slowly inched up. I'm hoping they'll come back down, but, you know, the economy's too strong, and I think they're pretty much going to stay where they are. I mentioned at the end of last year that rates will probably be closer to 4.5 to 4.75 by the end of the year. And that's probably pretty close to true because they're heading in that direction pretty well. There's a lot of people out there trying to figure out, do I want to go out and buy a house? Because with the rates up, it starts to affect what they qualify for. I've talked about how the feds have raised the loan limits, so it makes it easier. But what I'm seeing a lot of people do is refinance their home because of their equity and upgrade their home. There's certain things they can upgrade and actually add value. A kitchen gives you 80 to 90% per dollar. Bathrooms give you, actually, if you do the bathroom right, you get 100% back of the money you invested in value on the home.
Right.
So those kind of things are working pretty well.
Good deal. Their website, aimortgage.net. And again, their number, 720-895-0500. So, Kurt, tell us about our guest today.
Our guest is actually, he's my CPA. I've had him for quite a while. And with the new tax laws, I thought it would be good to bring him on so that people could call in and ask certain questions because, you know, you hear this side say this about the tax bill. You hear people on that side say this. What does it really work for the average person? Some of the things I don't like about it, some of the things he doesn't like about it, you don't like, but is it good for everybody? So I thought I would bring him on the show. His name is Michael Crouch. He's my CPA, works right across the hall, so it makes it real simple when I want to go see him.
Oh, okay, right there in your building.
Right across
good
the hall.
Deal. Well, he can't run, can he, Michael?
Yeah, sometimes too simple.
Absolutely. Well, give us a little background on yourself, how you got into this, where you're from, and all that.
Actually, for me, it started, I was a junior in high school, and the only class that made sense was accounting.
Ugh.
So I'm one of those few.
Hated those guys, yeah.
And then from there, I grew up in Loveland and went to Colorado State, and then moved to Denver about 1990.
Okay.
So Colorado native.
Good deal. So when we talk about a CPA, first of all, should everyone pretty much have a CPA?
That's a tough question. A lot of people would benefit from one. And there's different levels of tax preparer and CPA, and
right.
Not all CPAs do taxes, and not all tax preparers are CPAs. But there's enough in the law that it probably makes sense to at least entertain.
Right, because you're up to speed, hopefully, on
Right.
all the different things that are going on. And I mean, I don't think there's any way Kurt and I could be up to date on everything.
Well,
that
it's
we
a good
would
thing
need to
they
know.
didn't give these things to him starting at the end of February through March and April for him to learn the new laws.
Yeah, exactly.
I mean, that's the busy time for him. So they gave it to him in December, so he's had 30 days to work on it.
Wow. All right.
And not much in this law is effective for 2017, some depreciation issues, but most of this we're all going to see next tax season.
Gotcha. So tell us from your standpoint, we were talking a little before the show, you kind of work by referral only, but, you know, if people are going to, I think, you know, get a mortgage, they should go down and sit with Kurt, see what that relationship's like. Same thing with a CPA when you're hiring a CPA. Should you go and interview a couple to see who's a good fit?
I think it's always beneficial, and the best place to find a CPA is to check with coworkers and people you hang out with, different clubs or maybe your church or different organizations. But somebody who works really well with somebody is always a good place to start to look for a CPA.
Absolutely.
Yeah, I've known Michael for a while. Diana found him, went across the hall, and she connected right well with him because the CPA had an accident, and he's no longer with us. So I was kind of in a rush to find a CPA. He just happened to be across the hall. And working with Michael is easy because I bother him a lot. I tell him I need to bring money over because I'll walk across the hall and ask a quick question, and he'll stop whatever he's doing and he answers the question, and I know he's looking at me going, I wish that guy could doing that. But I keep bothering him all the time. Michael's a great CPA, and I agree with him. Having a CPA to answer your questions, just so you know the right way to go, even with the tax laws, because maybe you're missing something that could help you.
Right.
And we're going to go over some of those now.
Because a mistake can be costly either way, either to your benefit of not being able to take a deduction, or if you make a mistake the wrong way, come back when they add the penalties and all the different things could be very costly.
Exactly.
All right. So let's get into when does it start getting busy for you? I mean, what should people be doing now to get their taxes ready for April 15th?
Well, most tax documents should be mailed out by tomorrow.
Okay.
Investment accounts and all that have an extra 15 days, but the filing season did open yesterday. So if you're one of the 155 million people who need to file tax returns, you can start.
Man, 55 million. Wow. And so, and like 1099s, like I'm self-employed, and I have some people we paid, what is it, over $600?
Right, exactly.
Then you have to send them a 1099, and all those have to be mailed out by tomorrow, right?
Right, exactly.
Okay.
The interest has got a $10 limitation. Services provided has the $600 limitation.
Okay.
So, the reason you're on the show is we're going to talk about tax laws. You and I have had many conversations. On a whole, let's take it from the overview of it. Do you think that the tax law will benefit middle-income America more than what was currently in place?
In a very general statement, I think the tax law will benefit most Coloradoans with their taxes.
Okay, and one of the reasons is what? What's the core reason that it will help most people?
I think the lower tax rates will help. That's probably the biggest. And the fact that the credits for kids and dependent children have expanded, and more people will be able to qualify for those.
Okay, let's talk then first about the lower tax limits. Prior, and Trump talked about this, about how he cut brackets down. In that, how much did he cut the brackets? I mean, where's the biggest portion of that cut?
The lower two brackets have gone down by 3% apiece, from 15 to 12, and from 25 to 22.
So your tax liability kind of almost goes away at that income level.
It will go down. Instead of having those top dollars taxed at, say, a 25%, now you can have a majority of those dollars taxed at 22%.
Okay, and that affects anybody making anywhere from where? 50, 100,000 a year, where?
Yeah, on a joint return that covers you pretty much up to about 155.
So,
yeah,
3% is that's a quick little one.
Sure.
Pretty. Now let's talk then about the standard deductions. Standard deductions before were 12.5.
Right.
But that's for joint. What's changed?
So on a single is now 12,000 flat, and the married filing joint is 24,000. Now, so if you start itemizing your deductions and you don't hit 24,000 on a joint return, then you just use the 24,000 standard deduction. The deductions that you would add up to see if you're over 24 would be medical, your taxes, which we've all heard has been capped at $10,000 for your income tax, your property tax, and your car tax. And then you still have your mortgage interest and your charitable donations.
All of those cannot exceed 24,000.
If they do exceed 24, then it benefits you to itemize rather than to.
Well, that should be easy to do with our health care monthly bill.
Well, that was the question I was going to ask. Does the monthly bill counts towards the health care?
Monthly bill?
Well, for example, my bill is $800 a month.
So that's included in your deductions.
Right.
Yeah.
Right. Some people, if you're business owners or self-employed, there's other places to take that medical deduction, but mostly out-of-pocket medical. Not a lot of people have been hitting because there's thresholds on that too. You can't exceed 7.5% or 10% of your income. You have to get over that amount before you even get $1 of deduction. So the medical for working people,
pretty
isn't
much
one that,
zero.
Yeah, it doesn't get hit very often.
Because if you're making $50,000, you got to spend $5,000 before you can even start to add any of that to the. Am I correct? in that?
Exactly. Exactly.
So medical isn't really that big a portion of it. So now you're dealing with charitable donations,
Right.
and then the interest on your home.
Right. Which
And
are
it-
some changes in that area for later.
Yeah, we'll get into those in a bit. And then taxes on your
Taxes.
home.
Income tax, property tax, and there's an ownership tax on your car are the three big ones.
That are all part of that 24,000.
Yeah, in that section itself, those three are capped at 10,000. You could pay 12, but for this calculation, only 10 of it counts.
So even if you're paying more, you're stuck at the 10.
Right. Right.
303-477-5600. If you have any questions for Michael, we'll open up the phone lines. Again, this is a great time to get some free answers from a qualified CPA. And again, when we have people on like this, we've either checked them out if we don't know them, but most of the time, Kurt, we know these people, and we're saying, hey, well, if you use him, that's a good enough testimonial right there.
Yeah, he's pretty well kept me in line. He'll tell me some things, and I might not want to do them. He'll say, I told you to do this. Okay, then I'll kind of do that.
So 303-477-5600. So as self-employed people, we always look for all the deductions, that we can. Are there any that are sometimes commonly missed as you look at some of your clients and different things that, are tax deductible that maybe some of us don't think about?
They're not. As self-employed and, having the requirement to keep a separate business account, and you prefer you have a charge card or a debit card that's tied to that account, it's pretty easy to track what is utilized for business purposes when you start expending the money. The things that don't get run through there exactly are some kind of the harder ones, which require more documentation as well, such as your auto usage and mileage, because it's not really, you don't write a check every month for
Sure.
your auto usage. Then you have to weigh whether the office and the home deduction is worth going through the calculations, and if there's enough benefit there to put that on the business.
Now, the mileage and mileage logs. So if I drive from my house to Kurt's office, I have to log that as an appointment, correct?
Correct.
What all are they looking for on that mileage log? Do I have to write down the person I'm seeing? I mean, how specific do you have to be?
It's a tough call, but the better the log, the better the chance that it will survive the audit process.
Okay.
When it comes to that. The
Well,
business.
I hate that. I mean, 'cause I'm
Well,
all
for you,
over the place.
Yeah, you're all
you
over
know?
the place.
I mean, I may go to you, then all of a sudden decide to go somewhere, and then before I know it, and I drive 35,000 miles a year around Denver.
Right.
Okay, I have OnStar in my truck. That keeps a computerized log of every mile I drive. And I got into an argument one year, which they won, but I got into an argument one year because I'm saying, look, this is a calculated thing from OnStar. This isn't something I made up. And here's 34,000 miles that I drove. You can look at my last 8 years of history. I've driven that every year of my life. Take off 20%, 30%, whatever. But no, I mean, they wanted, starting mileage, ending mileage, who you were seeing, what it was for.
Business purpose.
Gee.
Yes.
But it's worth a lot of money if you drive that kind of mileage.
It is.
Yeah, for that kind of money.
So
yeah,
you
it
kind of
is.
get paid for doing it.
Yeah.
But I can never remember that because it makes me so mad to do it.
A lot of folks in my business now are going paperless, so it's actually cut my miles time in half. But there for a while, I was driving, and I would just say, okay, customer's name, and I would put address, calculate the miles, and I would add them up. But it's been reduced so much for me, it doesn't add up to as much as it used to.
And what is it a mile? Right. Not to put you on the spot, but roughly.
Last I think it was 54 cents a mile.
Okay.
I don't know if that's current or
Right.
last
Well,
year.
that takes the gas price down to about
Sure.
$1.60.
Absolutely.
I like that.
You're listening to Haystack Help Radio and a special edition of Your Money Matters. Kurt Rogers in studio with us from Affordable Interest Mortgage. So if you got any mortgage questions, we'll take that as well. But also Michael Crouch, and Michael's a CPA. So again, Our phone lines are open, 303-477-5600. Cassie's run our Facebook Live. You got a question, Cassie can get us that through Facebook Live as well. Just go to Haystack Help Radio on Facebook and catch us there. We'll be right back.
What could you do with an extra $500, $1,000, or even $1,500 per month? How would that change things for you? Would you buy a new car, pay off bills, or just feel a bit more secure about your retirement? What if I told you there's a way to make your dreams a reality? I'm talking about trading and investing in the market. Now, before you say, oh, that's not for me, just hear me out. I want to invite you to a half-day trading course so you can check this out. I promise you, you'll go away smarter than when you came in. We here at Online Trading Academy sponsor this, and we'll even send you home with a free home study video guide. Your money's doing nothing for you in a CD or mutual fund. Learn how to profit when the market's up or down. Call us now while seats are still available at 303-325-2776. Use offer code Radio50. 303-325-2776. That's 303-325-2776.
Worried about losing the tax deduction of your mortgage interest? Now, more than ever, it's important to stop paying more interest than you should. Take AIM, Affordable Interest Mortgage. If you have a second mortgage, those rates are going to continue to go up and up and up. Let us show you how to take advantage of higher conforming loan limits of $529,000 at lower fixed rates. Credit card rates will also continue to go up. Pay off those high-rate cards now and save thousands in interest. Take AIM, 720-895-0500. Call now to save over $100,000 in interest and own your home faster, all without changing one penny of your current spending habits. It's only your money. Take AIM. Paying mortgage insurance is like adding over 1% to your current rate. Stop paying it. Refinance or purchase your next home with only 3% down and no mortgage insurance. Call 720-895-0500. Let AIM save you thousands like we've been doing since 2001. 720-895-0500. That's 720-895-0500. Take AIM and take control of your money. NMLS 298191. Regulated by DOR. Equal credit lender.
Lone Tree Veterinary Medical Center offers KLZ listeners complete pet care services every day, all at one location. It's so much more than a clinic and so convenient. Their expert staff is always happy to help your pet have the happy and healthy life it deserves. Schedule a medical checkup for your beloved companion or take the first step toward a better behaved buddy by signing your pup up for obedience training. Did you know that if your sweet kitty needs grooming, Lone Tree Veterinary Medical Center is one of the few facilities that offers grooming for both dogs and cats. And if you're planning a vacation, Lone Tree Veterinary Medical Center offers boarding for dogs, cats, and other small pets so you can take your vacation without worry, knowing that your four-legged family member's home away from home has a fully equipped medical center on site. Learn more about Lone Tree Veterinary Medical Center at lonetreevet.com or call 303-708-8050.
Need a new pickup? Lynn Lyle Chevrolet is having its Silverado year-end clearance sale, with Silverados starting at just $26,900. Lynn Lyle Chevrolet always has the lowest prices. Lynn Lyle Chevrolet, I-225 in East Colfax, or on the web at lynnlylechevy.com.
Rush to Reason with John Rush, weekdays from 3 to 7 on KLZ 560.
Welcome back to Haystack Help Radio. My name is Scott Watley, along with Kurt Rogers from Affordable Interest Mortgage. In studio, Michael Crouch. Michael's a CPA. If you've got any questions, our phone lines are open, 303-477-5600.
Okay, we were talking about mandatory deductions being increased up to 24 for a couple. Did we lose any itemized deductions with those changes?
Yeah, the one we lost was what we call the miscellaneous itemized deduction section. It would anything over 2% of your income, you could start deduct your financial advisor fees, your tax prep fees, your unreimbursed business expenses, and that section is going to be completely gone off the return in 2018.
So it's like a junk drawer. It's just now gone.
Yes.
Everything you just kind of want to throw in there. Okay, I can't do it no more.
Right. And I think the one that's going to affect people is the salespeople or different people that have a lot of expenses that they pay that they don't get reimbursed from their employer.
Oh, yeah.
It's going to have a material effect on their returns.
Oh, really?
So,
okay.
Yeah, that's what I mean. It's a junk drawer. Okay, I'll throw this in here, I'll throw this in here. Can't charge in the financial planner.
Sure.
That's yeah, okay, well, that's gone. Okay, let's talk about the things that fit into the standard deduction that they have to exceed the $24,000. And you talked about charitable donations. That's going to hurt a lot of charities. Do you believe that will?
It comes down to people's intent when they donate. If it was for the tax deduction, that's going to have an effect.
Correct.
And people that donate out of their own goodness of their heart and their philanthropist attitude,
yes,
they'll still donate.
Yeah, the numbers that I'm seeing is that they think nationally it'll cost $3 billion in losses to all different types of charities. The church I go to, I've talked to some of the pastors about that. They're kind of keeping an eye open as to what that happens, because a lot of people like that will get into an IRA for a tax reason. They'll give money to a church because they get to write it off. So there's going to be a ripple effect to that, I believe.
So if you have like we do a lot of things with our Sportsman of Colorado show, like the Rocky Mountain Elk Foundation, they're a 501c3. So let's say I give $500 to them at their banquet in March. Is that $500 deductible when you give it to a 501c3 like that?
Yes, it's deductible, but what may happen is if you haven't exceeded that $24,000 for your you're going to get no tax value for it.
I gotcha. Okay.
You're coming in at $19,500, $20,000.
Yeah.
No, you're going to take the 24 that the law allows.
Yeah, when you're adding up those deductions plus your interest on your home and the taxes that you talked about, if it equals $10,000 hypothetically, if that doesn't exceed 24, then none of those deductions
benefit you
for tax purposes.
And all of you, and does that include church contributions like he's talking about as well? Okay.
That was one of the parts of the tax bill that I didn't like.
Right.
So it's either going to take people that have been maybe giving $5,000 a year and say, okay, I got $19,000, I'm going to jack in another $5,000 so I get to count it all, because now it becomes more itemized. They might throw in more. I don't know. But that was one of the things that I wasn't too fond of, that we've lost that deduction.
And I do think there's a couple of strategies involved there, and I think one of them I call it the grouping strategy. What you might, if you're somebody who's close, some years you're at 21 and some years you're at 28. So some years you can itemize and some you don't. You need to look and, as part of your plan, think, this is a year I'm going to exceed. I'm going to go ahead and donate to my church or to this sportsman show this year, even though it's December, because I'm going to exceed the number and I don't plan to next year. So you might start grouping your expenses into a year.
Yeah, planning it out. If I've had a good year, okay, I'm going to give more.
Plan? Plan? You mean I got to plan something?
Salespeople plan? No, we don't plan any of that stuff.
Hate that word.
Okay, so now we come down into interest on a home. And for years, everybody says you buy a home, you now get the deduction. Well, you do, except for it has to be in excess of $24,000 with a combination of all these other items.
Correct.
So a lot of customers are saying to me, well, if I do this loan, am I going to be able to write the deduction? That's something that they need to see their CPA on. But when you start looking at the interest paid on a home, if you're dealing in, let's say, a $250,000, $300,000 home, you're going to pay in approximately maybe $1,000 to $1,100 a month in interest on a brand new loan. Well, that's going to equal about $12,000. That interest is now gone as far as being able to deduct it, because they're actually giving you more by going to 24. It's not a negative, it's a positive.
Right.
Because you got 24,000 where you're only really coming up with 18.
Right.
So I'm not trying to make it sound like it's a bad thing. So when people are looking at, that's some of the things they need to consider.
Right.
Go ahead.
Well, and I think that's where, as you start to see that, okay, now you're buying a house and this year you might get close to that number, do you pay the property taxes early, which is what the response was from a lot of people that were planning in December, was to pay that before you could lose the benefit. I think it's going to be the same with your interest. You want to pay an extra month. Is this the year I'm going to itemize and I want to get that 13th payment in?
Yeah. You need to plan it better.
Yes, that's where the CPA or the plan, it may not be for the return preparation itself, but there's some planning that can be done. There's some donations that could be done directly from your IRA. There's things like that you can have the conversations about and plan and lower your taxes long before you start getting into the actual preparation of the return.
Right. Instead of waiting to December 15th.
Sure.
I got to crush all the stuff in.
Now,
or February 1st.
Yeah.
some of the stuff with the homes, Kurt, the way I understood it with some of our financial planners is if you already have your home and you're not buying a new and all that, you can keep deducting like the second mortgage and all that. Is that true? On an existing home?
I'm chuckling because I've had this conversation with Michael.
Okay.
I'll let Michael answer that one.
The home equity portion of the loan is no longer going to be a write-off, whether it was done before December 15th or after.
Done.
The home equity is gone, starting in 2018, not this year that you're filing in the next couple months. Now, if the loan was originated before December 15th, 2017, and the loan is $1 million or less, then you can still write off the interest in full.
Okay, that's what I was getting to there.
Mm-hmm.
So
Yes.
less than $1 million done before the December 15th?
Correct.
2015,
2017.
2017. Then you can still deduct that.
Right.
Correct.
Okay.
The change on that would be if it's after December 16th, the cap is now $750,000.
Yeah.
Not
Stop
the
from
$1
$1 million to $750.
Okay.
And to be honest, that's appropriate. That's
most,
not a
isn't
big
it?
deal.
Yeah.
Well, can be in Colorado because the price of homes are going up. We're soon going to be there.
Sure.
But now we're going to talk about home equity lines of credit, which is a big thing. A home equity line of credit versus a home loan. One of the things people will say, well, I have a second mortgage, I don't have a HELOC. One of the things that makes a difference is a home loan is a second mortgage that's fixed. A home equity line of credit or HELOC is a second mortgage that's adjustable. That's the part that you get no deduction on that, even if you exceed 24 with everything else. You still get no deduction for that, correct?
Yeah, I think we're going over the next 11 months, we're going to start figuring out what the definition of the home, what's home equity
Right.
indebtedness versus what's a second loan. And because that's the thing we're unsure of. Is it just the first and then case closed? And then how can you distinguish, and where was the money used? Where were the proceeds from the loan used? Was it used to buy the home? Was it used to improve the home? Or was it used to pay off credit cards and all that, which is going to have an effect on what you can deduct?
Which is where I was headed with this conversation. A lot of people don't understand, and I want you to explain it to them. When you take money out on your house, even if you exceed the 24, you may not legally be able to write off some of that interest because you're not spending it to improve the home.
Correct.
You're taking a vacation. Explain that to them.
Well, the hard part we're going to have to start doing is probably tracing where the proceeds go from new loans. If it went to buy a home, and the home is less than $750,000, then we don't have much issue. If you pulled the money out, bought a second home, paid off credit cards, improved the home, we're going to have to start tracing where those proceeds went and what percent of this loan is going to be deductible versus non-deductible.
Yeah, because if you take money out, let's say you pull out $50,000 and you go buy a car, that didn't improve your home. That's not a deduction. I don't care if you're above 24. But if you spent the $50,000 to improve the home, now it goes into a different bucket. And that's, again, coming back to a CPA needs to explain that to you before you make those decisions. While you may try to get away with it, Michael brought up a point. When you're deducting interest, nowhere on the tax forms does it say this was a home equity line of credit or a fixed. It just talks about interest in a big bucket. Well, that's all probably going to get fine-tuned, like you said, in the next 11 months.
And it's interesting, for the last 2 years, the mortgage statements, the tax form actually had the origination date of the loan on them. And we always thought that was kind of a unnecessary item, and then here the law passes that makes that a very appropriate discussion point.
Yeah.
What about reverse mortgages? Will this have any effect on tax stuff with reverse mortgages and what they
Because
do
it's
with
all
the
going
money?
back to the home because it's not a forward mortgage, it's a reverse. So it's increasing it to the payoff. So, yeah, it doesn't affect those at all. It does affect second homes. Second homes, you cannot write off the interest on a second home, period.
Well, the second home, the first and second home come under the same $750,000 cap or $1 million cap if they're. So if one loan is $500,000 and one's $300,000 and they were both acquired in 2018, you will have to start prorating because now you're over the $750,000. But the second home, if the loan is tied to the second home, you can still write off some of the interest. Now, if you go out and borrow against your first home and buy a second home, now now you've got to start tracing where the proceeds went and do an election and this kind of stuff to say this is for my second home, because now you have a first and a second on your primary. It's going to.
Now you know why Michael's here.
Yeah. 303-477-5600 is our number. If you've got questions, I'm telling you, I don't like them looking into our money at all.
Yeah.
All right. You're listening to Haystack Help Radio, special edition of Your Money Matters. We got to take a short break, and we'll be back with more right after this.
Littleton Heating and Air Conditioning is proud of their 45 years of HVAC service to Littleton, Highlands Ranch, and Denver metro area. Littleton Heating and Air Conditioning is your Lennox and Carrier expert heating and air conditioning contractor. They are proud to offer the finest heating, air conditioning, and indoor air quality products with prompt and professional customer service and satisfaction. Call today and mention Haystack Help Radio and save $25 off any repairs or $100 off your furnace installation. Call 303-798-3880. That's 303-798-3880 for your appointment today. Littleton Heating and Air, A-plus members of the Better Business Bureau and official Haystack Help registered company.
I was in a car accident and I was hurt. Bad. My life was instantly turned upside down. I can't work. My insurance company is not treating me like family, like the commercial said they would. My car was totaled. I had some savings, but all of that is gone now. And on top of all of this, the person who hit me didn't have insurance at all. I don't know what to do.
After you've been in an accident, call Kevin Flesh of Flesh Law. He will answer all of your questions. Kevin Flesh will help you to determine if you're entitled to compensation for your pain and suffering. And he has the experience and the knowledge to navigate the complicated maze created by the insurance companies designed to minimize your claim. Call Kevin Flesh of Flesh Law at 303-806-8886 to find out how he can help you get the compensation that you deserve. That's Kevin Flesh, 303-806-8886. Call now to get your life turned back around.
Ladies, I know you're tired of walking into the local gun store and seeing the same old thing. So let me tell you about Rampart Firearms. Just a quarter mile up Highway 67 off of Santa Fe and Sedalia, you will find a great selection of guns, ammo, tactical, and personal defense weapons. And if you or your spouse love to hunt, Rampart Firearms is a great stop for all of your hunting needs. Shotguns, rifles, pistols, anything from predator hunting to your next big game trip. Head to Rampart Firearms at the foot of the Rockies. Open 6 days a week, Monday through Saturday, 10 a.m. to 7 p.m. And you will only pay a 4% tax on your purchase. RampartFirearms.com, 720-468-0050. That's 720-468-0050.
Don't fall for gimmick ads when choosing your insurance coverage. Group Insurance Analyst has been Colorado's insurance superstore since 1984, where customers can compare and shop for all of their insurance needs. At GIA Insurance, their brokers have no allegiance to any particular health, auto, or home insurance company. Take advantage of their experience, expertise, and exceptional client service. For your free quote, call today at 303-423-0162. That's 303-423-0162. Visit their website, e-gia.com, or stop by their office at 44th and Garrison Street in Wheat Ridge. Group Insurance Analyst is an official Haystack Help registered company.
Got a question for the station? Email info@crawfordbroadcasting.com. Now back to Haystack Help Radio.
And we are back. You're listening to Haystack Help Radio, special edition of Your Money Matters, brought to you by Affordable Interest Mortgage. Once again, your one-stop shop for all your mortgage needs. Give Kurt and his crew a call over there if you've got any questions about mortgages, 720-895-0500, aimortgage.net. Today, our guest, Michael Crouch. Michael's a CPA, and we've been going over this new tax deal and all the different things there. And Michael, you brought up a good point during the break here. I mean, wow, you guys have had a very short window of time to look at this. And we don't have to worry about it right now for you filing everybody's taxes and all that. But, I mean, how would they expect you guys to be able to really, answer questions and do all this in just a short time? Wow.
Yeah, it came up quick. And you read and you try and understand the best you can. And I was talking to people in my office, and I said it was funny when the 86 law passed, I didn't come in to start doing taxes till about 91, 92, so people could tell me what had changed and how we were going to go forward. And now we've all kind of had this for about 30 days and trying to figure out what we can do to help people plan and to get ready for next year. Because one thing I do think that's going to happen is people are thinking that the taxes are going down. And like I said, generally, I think most people's taxes will go down. But what you may see is not a big change to your return next year, because you'll see your paychecks slowly increase maybe over the next couple paychecks as they've reformed the tables. And we saw this with some of the stimulus packages a few years ago.
Right.
Is, okay, now you mysteriously have an extra $70 in your check, and at the end of the year your taxes fell $1,000, but you've had $900 of it already kind of given to you through your checks, and there really isn't much material change to your return. So you may not be getting the big windfall you think when you actually go to file the return. I can tell you that your taxes have gone down, but the other side of the equation is what you've paid in has gone down also. So just want to caution people not to go out and think the money's coming a year from now.
Right. Kurt's going to get into some issues with homes here in just a second, but one other question I had real quick was, we saw several companies, and I think Southwest Airlines came out last week, said they were giving big bonuses to employees. What has been good for the companies so that they are doing these bonuses?
Well, the company's got a new tax rate that was kind of lower than it was before and kind of a flat amount.
It went from 35 to 28 or something?
Yeah, it was a graduated scale, but some of them could hit the 35% bracket. Now it's just a 21, and so
that benefited a lot of people.
Businesses.
Coming back to the standard deduction, a lot of people, when we talk to me about the interest on the home, that they feel they're losing that. But when you put that number together, that $24,000 actually is a benefit to them.
Right.
What now becomes more important is you really need to paying attention to the interest you're paying on your loan. Now, with rates going up, that means you're going to pay more, but there's still ways to cut that. A lot of folks, the asset manager is a perfect example. Even though it's a home equity line of credit, you can pay 40% less interest on your home faster with the same money. So you're not only getting the $24,000, you're saving 40% of the interest. But if that doesn't work with you, maybe take a shorter term, because you may take a 27-year versus a 30. You're going to save maybe pay $75 to $80 more a month. You're saving tens of thousands of dollars in interest that you can't write off anyhow. So why pay it?
Right.
So again, coming back to the CPA and why you should talk, how do I put all of this together to make it fit, is something that's really important, because the 24 is a good benefit, but how do you go about not paying interest on the other side of it?
Right. And that was something we've seen over the last 10 years. People were getting the same refunds for a while, and then all of a sudden their refund went down or went away, and they're like, Mike, what happened? It's like, well, you refinanced and you've paid a lot less interest, and that's a good thing.
Yes.
And this is the same type of thing. If you can't hit the $24,000 on a married return, and they're going to give it to you, then you take it. But
take it.
Yeah, you still pay as little of interest as you can.
Now,
let's go to the phones real quick. We've got Wally on the line. Wally, you're on Haystack Help Radio. How are you, sir?
Good. How are you guys?
Good, man.
So I got a comment and then a couple of questions.
All right.
I'm gonna comment on the standard deduction and the interest. So let's say that you spend $15,000 a year in mortgage interest. What I was taught, because I am a Dave Ramsey fan, would you rather have that $15,000 in your bank because you've paid off your loan, or would you rather give the government, pay $15,000 in interest in order to save $5,000 on your income taxes? Because even though you're paying $15,000 in interest, you only get to it only affects in real ratios about a third of your tax rate or your tax bill. Am I correct on that?
Yes. Yeah, there's not a deduction out there that is worth more on your tax return than it is in your pocket. So
right, but we've been led to believe that you got to have a mortgage to deduct you need that interest deduction, and now with the $24,000 standard deduction, to me that would be more of an incentive to get your house paid off and not be paying any interest to anybody, because you're still getting the $24,000 deduction.
Yes, yeah, that's correct.
If you're married and filing joint.
Mm-hmm.
So now that the comments out of the way, under Obamacare, you could have a Christian Medishare type medical program that qualified you so that you didn't get hit with the penalty, but you could not deduct the cost of the Christian Medishare insurance. Did that change now that the mandate is gone? If I have Christian Medishare, will that expense be deductible now?
No, my understanding is that is not an interest. That's not an insurance payment. That is a community pay into the community, and there's not a deduction for that. And the mandate isn't gone for 2018. It's got one more year.
But Trump effectively said don't enforce it, didn't he, last year?
That was 17, but there on your 17 returns, you have to disclose your health insurance and how you complied with the mandate.
But Medishare does fulfill that requirement of Obamashare, because I personally have it.
Yes.
And I've been confirmed. It does meet that requirement for having insurance, even though it's not an insurance.
It's not a
It
deduction.
grandfathered in from years ago.
Yes.
Since you have it, have you ever had to use it?
Actually, no. I'm actually going in February for the first time to use it.
Oh, okay. Because we were with Kaiser, and I'm switching over because Kaiser was going to be like $1,800 a month this year. And
yeah, I know.
It's like that's almost as much as my mortgage. So
that's why they reduced the interest on mortgages, so you can buy more health insurance.
Yeah.
Now, can you do a health savings account or anything like that if I'm doing Christian Medishare?
I don't.
So that you get some deductibility?
That I'm not 100% sure on. Most insurances say that they're HSA eligible. There are certain requirements to have an HSA, zero copays and different things like that. I actually don't know if Medishare qualifies.
Wally, if you'll listen Thursday, I'll be doing a show with Paula Nigro over at Group Insurance Analyst.
Okay.
I'll make a note, and we'll try to bring that up.
And we've talked
about that with
Greg.
By the way, that's who I have all of my insurance with.
Yeah, they're awesome. Group Insurance Analysts or brokers.
Yana is absolutely phenomenal over there. And then I'll make a comment. This would affect you greatly, Scott, since I don't drive quite as many miles as you do, but I have never understood why that they give the same 54 cents for a guy that's driving a Prius versus a guy that's driving a Silverado.
Yep, I agree.
Why don't they have different weight classifications of vehicles and the mileage deduction, if you're doing mileage and not actual expenses, be more based, because you know that you're consuming more gas in a Silverado than you are a Prius.
Sure.
But that just makes my job harder.
Deduction rate.
Mike said that would make his job harder, but it would sure help me. That's for sure.
So I mean, I'd love to have like an 80 cent per mile deduction for my truck for work. But,
yeah, no kidding.
Real
quick, Wally, I'm going to give you a 60-second commercial. Tell us about your roofing company.
Thunderstorm Roofing. I've been doing roofing in Denver since 1991. I'm a very small company. As your wife that helped me with my website said, she would call me a boutique roofer. I'm more into wanting to do the quality jobs than a lot of quantity. And just to give you a quick, for instance, with a couple of insurance things this year, I had one insurance claim that started at $19,000, and when it was all said and done, we were at $56,000. So if you have been turned down, I'm getting ready to help a gentleman that's right in the middle of the hail area. He got turned down by State Farm, and he has very obvious hail damage, and I don't think there will be any doubt that we'll get that paid. But if you've got a claim where you don't think that they're covering things, it's just a matter of coming in and looking at everything, doing supplement requests, and getting them to pay you for it. So
absolutely.
And my number is 720-541-0705, or you can go to Victoria's website that she designed for me at thunderstormroofing.net. And if anybody needs a website, call Victoria. She does a great job.
Well, I appreciate that, Wally. Thanks for listening. And be sure and listen on Thursday, and I'll get with Paula Nigro, and we'll figure this insurance deduction out, too.
Okay, that's the big thing that's affected me is the health insurance.
Sure.
So,
Okay, bud.
okay, have a good one.
You too, man. You're listening to Haystack Help Radio and a special edition of Your Money Matters. We got to take a break. Be right back.
If you're looking for great deals on outdoor equipment and clothing, we've got you covered. Hi, this is Bill Paddock, owner of the Outdoorsman's Attic, your outdoor gear consignment headquarters. You'll save 20, 30, 40, even 50% on previously owned outdoor gear for the fisherman, hunter, and camper. We also sell live bait, firearms, and ammo. If you're doing a little spring cleaning, bring in your gear to the Outdoorsman's Attic. We'll sell it for you and put cash in your pocket. You can also pick up your hunting and fishing licenses right here at the store. Your one-stop shop for all your outdoor gear needs is the Outdoorsman's Attic, located at 2650 West Hampton Avenue in Sheridan, Colorado. 303-781-3626. That's 303-781-3626. Or visit us online at outdoorsmansattic.com. Mention Sportsman's of Colorado and receive 20% off all your outdoor clothing.
Hi, this is Scott Watley. Let me tell you what I love about Stack Optical. They are truly one of the last optician-owned, family-owned optical stores. At Stack Optical, you can be confident you'll receive personal attention. For over 50 years, Alan Stack has shown he really cares about making his customers happy. Stack Optical also has a beautiful new location at 2233 South Monaco Parkway in Denver. Free and easy up-close parking. Stack Optical has an on-site eyeglass production lab. Whether you need office eyewear or a new set of shooting or golf glasses, Stack Optical has the solution with the Stack Sport Pack. Give them a call today and ask for their $69 eye exam. 303-321-1578. That's 303-321-1578. Your eyes and vision are one of the most important things in life. I'm confident at Stack Optical, you'll see the difference. That's 303-321-1578, stackoptical.com.
Lynn Lyle Chevrolet is having its year-end clearance sale on all new 2017 Chevrolets. Other Chevy dealers are offering 20% off. We're going to top that. We're offering 30% off on new Chevrolets. Lynn Lyle Chevrolet, I-225 in East Colfax, or on the web at lynnlylechevy.com.
Rush to Reason with John Rush. Weekdays from 3 to 7 on KLZ 560.
Welcome back to Haystack Help Radio. Mr. Kurt Rogers is with us from Affordable Interest Mortgage. Once again, their number 720-895-0500. Mike Crouch is also in studio. Mike's CPA. And Mike, I tell you, this is going to be a mess for a lot of people. I would highly recommend people find a good qualified CPA, Kurt. If they
have a conversation.
If they just own a business, whatever, just to make sure that, one, you're following the laws, because everybody wants to do that. But I'm telling you, I think it's just going to be a mess.
With the changes, you have to understand where they are so you can figure out, like Michael says, where do I put my money to get the biggest bang for that? How do I change things to make it work for me? Mm-hmm. So I agree with you. We need a CPA. Mm-hmm. One of the questions I didn't get to earlier was about investments, the interest on investment and the depreciation and all of that. Has that, or is there any change to that with the new tax laws?
So when I think investment property, I think active rental unit,
right.
Whether it's commercial or that is on a different schedule. So that is not subject
Schedule
to
E.
Schedule E, as opposed to the itemized deductions we've been talking about. It's all on Schedule A. So there hasn't really been any change in that area. There's some benefits, which we probably won't go into. But if you're an owner of a pass-through entity like an S corporation or LLC, you own a rental property, you have a farm. There's the whole business side of this tax law that passed that's going to affect those people, and those people will definitely need some professional help,
right.
I think.
But they probably already have it.
Right. And there's going to be some good deductions, but there's some things that are going to have to be looked at.
Real quick, a business question, then we'll got a few minutes left here. We'll get into some things. How would you advise people whether to do an LLC or like an S corp? How do you go about differentiating what's best?
It depends on what the business is going to do. I'd like to work with service businesses, and the S corp is probably the best fit. They're employees of their own company, and the S corporation doesn't pay any tax. The tax flows through to the owner's return. Now, if you have rental property, then that's a different animal, and that would be better in LLC, whether it's a partnership or solely owned. Still passes through to you personally, but rental property doesn't really have a benefit being inside of a corporate structure.
Okay. And then I heard that it does cut down on audits too. You're less likely to be audited if it's an S corp rather than LLC. True or false?
That's true. Statistics would bear that out.
Okay.
Yes.
Good deal. All right. Let's talk real quick about, are there any changes to the primary residence?
No, luckily there was a change on there that I was extremely worried about for clients that were going to move in 2018, that the rules were going to change, but without going into them, they did not.
Okay.
The final version, it's still, if you live in that home 2 out of the last 5 years, 24 out of the last 60 months, as your primary residence, you live in it and own it, the capital gain exclusion is still $250,000 per person. So if you and your wife both own it, it's a $500,000 exclusion before you start hitting taxes.
Now, we brought up a customer that I have that's been in their home for about 18 months, and they're thinking about selling it, and they're worried about capital gains. Something you clarified to me is the capital gains is from the price they pay for it, plus any expenses to the home. Could be the closing cost on the new one that they're buying or when they're selling it, or any improvements that they've done to the house.
Yeah, not the new one that they're buying, but the one that when they sell it.
Yes.
The commissions and all those other closing costs. And you want to look back to when you bought the house. You have title insurance and different fees like that you can add to what we call your basis to increase that purchase price and lower the gain.
Yeah, yeah, because under 2 years, you do have the capital gains issue, but you get to deduct these things away from that, so you might only have a $5,000 or $10,000 gain, which isn't that sufficient.
Right. The Colorado economy is what it is, that you could have a gain even though you pay some closing costs on both ends. That wasn't the case a few years ago, but now
it's definitely there.
It's there.
So if you've done any improvements, you get to write them off also.
Right.
And I do think that's something people will want to keep track of going forward, because you see that when they start looking at an area, it's not that hard for them to change the rules to that area. And if you put on a deck or a fence or you repaint the house, you do some things, I think we're back to where I'm going to recommend to my clients, go ahead and keep those receipts in a file. You may never need them. Maybe the $500,000 stays in place on a joint return. But I do think a time is coming where there's going to be more scrutiny in that area, and maybe the numbers drop. So you're going to want to keep track of the stuff you did over the life of owning this house.
Gotcha. Now, again, from a tax standpoint and all the taxes and all that with retirement planning, we do some shows with a couple of retirement specialists, but there's a lot to just keeping good records in there for just tax benefits and all that. I mean, how long should we keep our tax returns?
My general rule is it never hurts to keep the tax returns themselves forever, if it's convenient. The records that go and make up the tax returns, you have to keep 7 years from the time you filed them. So basically the 8th year.
Mm-hmm. Now, anything with retirement income that, from people, anything with this new tax deal that's going to affect them much?
Nothing that changed. I think, if you're retired and your house happens to be paid off, I think you might be some of the people that benefit from having the higher standard deduction.
Gotcha. Well, that would make sense. Yeah.
Oh, yeah, there's no interest you pay.
Now, the one thing I would say, if you're of age where they're requiring you to take minimum required distributions on your IRA, which is age 70 and a half, there's inside your IRA, you can do, if they come to you and say you have to take $20,000 this year based on the formula, and you're somebody that likes to donate to your church or different organizations, you can have the IRA make the donation for you and lower what you have to take. I'm assuming you're somebody that isn't going to use the standard or is going to use the standard, so you're going to get no value. You pull $20,000 out and donate $2,000, you're paying tax on $20,000. You can have the IRA make the donation for you, and now you only have to pull out $18,000 and pay tax on $18,000. And so I think that's going to be one of the big benefits.
That works pretty well.
Yeah.
I like that one.
That's been in place for a while. It's been permanent now. I think this is maybe the 3rd year. But before you pull out 20, donate 2, you're still paying tax on 18 because you'd write off the 2. I don't think you're going to have the ability to do that if you use the standard deduction. So that's a benefit.
So if you were in charge of all this tax stuff, Trump calls you and says, Mike, what do we do to make all this tax stuff simple? What would you do?
That's a good question. I don't know, because I do think there's a lot of things in here that make it simple.
Mm-hmm.
The standard, a lot of people are just going to have their their wages and use the standard deduction and
it's going to be
calculate their
easier
tax.
for them to file, isn't it?
Right. Yes. And then on the other side, you've got things that have gotten much more complicated, but for the most part, they benefit us as taxpayers. So I'm not going to complain too loudly.
Right.
But as far as how to simplify, I've thought about that. And, does this flat tax work? Does a consumption tax work? And I can't make anything. They have a hard job. I can't make anything make a lot of sense to me because if you go to a consumption tax, okay, we're just going to pay tax on what we buy. Well, I have to buy school books, and I have to buy medical insurance, and I have to buy things when I go to the hospital. Is that now subject to tax, and how much is that going to add to that bill? And so let's go look back and look at the income tax. But I don't think there's any easy answers out there.
Well, great information.
I told you.
Everybody needs a CPA. I know that after this conversation.
Yeah,
for
you
sure.
need to at least sit down and have a conversation with them so you understand where you're going forward, how to maximize your cash.
Yep.
And so you're not losing it or paying it too much tax.
Well, Michael, thank you very much, my friend. Great to have you in studio today. Kurt, thank you, sir.
Not an issue. I'm glad you were here, Michael.
Cassie, thank you for running our Facebook Live as well. Check that out on Haystack Help Radio on Facebook. If you missed some of the show today, you can catch us there. Hope everyone has a great day. Again, check out our website, haystackhelp.com. And our helpline is always open, 303-333-HELP, 303-333-4357. Have a great day and leave it right here on KLZ 560.
The views and opinions expressed on KLZ 560 are those of the speaker and do not necessarily reflect those of Crawford Broadcasting, the station, management, employees, associates, or advertisers. KLZ 560 is a Crawford Broadcasting God and Country station.